Welcome back to the deep dive. It is Friday, February 27th, 2026. And I have to be honest with you, looking at the stack of research we have on the desk today, I kind of wish I had just stayed in bed and pulled the covers up.
Yeah, it's a heavy stack today.
It really is. We are looking at a new report titled the Hindenburg Alarm, which is just, it's never a comforting name for anything involving your life savings.
No, it's certainly dramatic.
Yeah.
But looking at the data we have, the drama might actually be an understatement this time. This isn't just about red arrows on a screen.
Right.
It's about structural stress.
Yeah, and that's the distinction we need to make right up front for you listening. We are not just talking about normal stock prices fluctuating today.
Exactly.
The sources we're pulling from, which include a pretty intense daily market report, some truly ugly Treasury auction data, and court filings from a major credit collapse, they all point to something the report calls a market integrity crisis.
That phrase is doing a lot of heavy lifting. Market integrity crisis. We aren't just looking at a market that's expensive or overbought.
Right, it's not just a bubble.
No, we are looking at a market that is fundamentally confused.
Yeah.
We have a massive $1.28 trillion leverage bubble colliding with a very rare, very flashing technical warning.
And this is all happening against a backdrop that feels like a techno-thriller movie script, honestly.
It really does.
You've got this high-stakes standoff between the Pentagon and Anthropic, global tensions ratcheting up all over the place, and a cost of living crisis that is just absolutely squeezing the life out of the average household.
The macro environment is incredibly tense.
It feels like the noise level is at an all-time high. But let's start with the signal in the noise, the title of the report, the Hindenburg Alarm.
Right.
Now, I know technical analysis can sometimes feel a bit like, reading tea leaves or checking your horoscope. Why should a serious investor actually pay attention to something with such a theatrical name?
That's a fair skepticism to have. Usually I'd agree that single indicators are just noise, just a blip. But the Hindenburg Omen is different because it measures internal market fracture. It's not looking at the overall price.
Yeah.
It's looking at participation.
Break that down for us. What does fracture look like in the actual data?
Well, in a healthy bull market, you expect a rising tide to lift all boats. Most stocks should be hitting highs together.
Makes sense.
The Hindenburg Omen triggers when you have a significant number of stocks hitting new 52-week highs and a significant number of stocks hitting new 52-week lows at the exact same time.
Oh, wow. So the generals, like the big mega cap tech stocks, they are marching up the hill, but the foot soldiers are actively retreating.
Precisely.
Yeah.
It signals deep indecision. It means the headline numbers like the S&P 500 index itself might look totally fine because a few giant companies are propping it up.
Right. Apple, Microsoft, those guys.
Exactly. But underneath, the market is tearing itself apart. It's a tug of war where the rope is about to snap. And here is where it gets really interesting and frankly concerning.
Okay.
It's not just that we saw this signal once.
The report mentions a cluster, right? Which sounds like a medical diagnosis you really do not want.
It does, and it is. The S&P 500 has triggered its sixth Hindenburg Omen signal in just the past month.
Sixth.
In a month, yes. That is the critical differentiator here. A single signal can be a fluke, a glitch in the matrix, but a cluster of six. Historically, that kind of density is a much more reliable predictor of a significant crash or a major drawdown.
Wow.
It's the market screaming that the center cannot hold.
So the check engine light isn't just flickering, it's strobe lighting red in our faces.
Exactly.
And the report mentions this other thing, the McClellan oscillator, being negative. I promise I won't make you do the math on air, but logically, if the index is high, shouldn't the momentum be high too?
You would think so. But this oscillator confirms the rot we were just talking about. It shows that despite the index price being high, the actual momentum is gone.
Gone.
The volume of stocks going down is overpowering the volume of stocks going up. In fact, the risk-adjusted momentum is the lowest it has been since the year 2000.
The year 2000. The dot-com bubble.
Yes.
We're going to hear that year come up again today, aren't we?
Unfortunately, yes, we are. The parallels are getting harder to ignore.
So if the internal mechanics are this bad, if the soldiers are fleeing the battlefield, why is the index still holding up? The report points to a specific example with Block Inc. that I found, well, let's just call it perverse.
It is a perfect example of the current incentive structure in the market. Block shares surged over 20% to $65.50.
A 20% pop in one day is huge. They must have announced a breakthrough product or massive revenue growth, right?
No. They announced they were cutting over 40% of their workforce.
That is just wild. You gut the company, you fire nearly half your staff, and the market cheers and throws money at you.
It shows that the market is rewarding financial engineering over actual health.
Right.
Investors are desperate for margin expansion, even if it comes from eating the seed corn. It's a sign of a market that is running on fumes, desperate to squeeze out profit wherever it can because the organic growth just isn't there anymore.
Okay, let's hold that thought right there. We have a fractured market, flashing red signals, and companies getting rewarded for amputation.
Yeah.
If the technicals are this bad and the momentum is dead, why are prices still near all-time highs? What is physically keeping this thing afloat?
One word: debt.
This is the $1.28 trillion leverage trap from the title.
That's the fuel.
Yeah.
The numbers here are just staggering. In January alone, margin debt surged by $53 billion. We are now sitting at a record $1.28 trillion in margin debt.
Now, I want to be clear for the listener because we often hear debt is bad, but in finance, debt is usually just a tool. But this isn't corporate debt for building new factories, is it?
No, this is margin debt. This is purely speculative leverage. This is investors borrowing money from their brokers to buy more stock, betting that prices will just keep going up forever.
So they are doubling down at the casino.
Exactly. And year over year, that debt has jumped 36%. That is the biggest increase we've seen since the meme stock frenzy of 2021.
Which didn't end well for a lot of people.
Right. But there's a specific statistic in this report that really contextualizes the danger we're in right now. It compares this debt to the real economy.
Lay it on us.
Margin debt is now 6.0% of real disposable personal income.
That sounds, it sounds high. But in a world where we talk about trillions of dollars all the time, 6% sounds kind of small. Contextualize that for me.
To give you the scary context, that is nearly 3 times higher than the peak of the dot-com bubble in 2000.
Wait, 3 times higher?
Yes.
So relative to what people actually earn in their paychecks, we are 3 times more leveraged right now than the biggest stock bubble of the last 30 years.
Yes. That is the definition of a trap. When you have that much leverage in the system, you don't need a disaster to crash the market. You just need a decline.
Because of margin calls?
Exactly. If prices drop, margin calls go out. Investors are forced to sell their stocks to pay back the broker loans.
Right.
That selling drives prices down further, which triggers more margin calls. It becomes a vicious feedback loop.
It's the air pocket effect. When the buying stops, there's no floor, just forced selling.
But this brings up a massive psychological question for me.
What's that?
Why? Why are regular people taking this much risk? We aren't in the roaring 20s. People are incredibly stressed right now.
That stress is the reason. You can't separate the leverage bubble from the affordability crisis that's mentioned in the report. They are 2 sides of the exact same coin.
The disconnect between Main Street and Wall Street.
It's more than a disconnect. It's a direct causal link. If you look at the data since 2020, nominal wages, the actual number on your paycheck, are up about 31%.
Which sounds great on paper. The government points to that all the time and says, look, wages are up.
But we all know the big but coming here.
Yeah.
But when you adjust for inflation, real earnings are only up 3.7%. That is 6 years of stagnation. People are running on a treadmill simply to stay in the exact same place.
And meanwhile, the cost of simply existing has exploded. The report lists some of these price shocks, and they are painful to read.
They are brutal. Since 2020, utility gas is up 56%. Wow.
Motor vehicle insurance is up 56%. Electricity is up 41%. These aren't luxury items you can just cut back on.
No, you have to drive to work. You have to heat your home.
So you have a situation where the safe path, working a steady job, saving 10% in a savings account, literally doesn't pay the bills anymore.
Exactly.
When working doesn't work, people turn to the casino. The leverage isn't just greed. For many people, it's pure desperation. They are borrowing to bet on stocks because it feels like the only possible way to catch up to the cost of living.
That is deeply depressing, but it totally explains the behavior. It's not irrational exuberance, it's rational desperation.
Well said.
Now, speaking of people borrowing money and things going wrong, I want to shift to the systemic cracks the report identifies. Because it's not just retail traders maxing out their Robinhood margin accounts. The plumbing of the entire financial system seems to be leaking.
That's right. And this is where we have to talk about MFS.
MFS. This is the bespoke specialist lender mentioned in the court filings. Bespoke usually implies high-end suits, not bankruptcy courts.
In this case, Bespoke means unregulated, complex, private credit. The report describes their situation as a spectacular collapse.
What actually went wrong there? Was it just bad bets on loans?
It's worse than bad bets. The court filings mention serious irregularities and significant shortfalls in collateral.
Shortfalls in collateral. That's polite lawyer speak for the money, isn't it?
Basically, yes. The analysts estimate billions of dollars have been, quote, vaporized.
Vaporized, just poof, gone.
This is a massive red flag for the entire private credit market. We've seen a rush of money into these non-bank lenders because everyone thought they were immune to the strict regulations slowing down traditional banks.
Right.
But if MFS is collapsing because the collateral wasn't real or just wasn't there, you have to ask yourself who else is sitting on a pile of vaporized assets.
It's like finding termites in your basement. You see one, but you know there are thousands more inside the walls.
Exactly.
And while that is happening in the shadows of private credit, we had a very public disaster in the most important market in the world, U.S. Treasuries.
The bedrock of the global financial system.
Supposedly. But on February 27th today, in the timeline of our deep dive, there was a 7-year Treasury auction. And the report calls it an absolute disaster. Walk us through what happened.
It was ugly. The auction had a massive tail. It stopped at 4.39%, which was 2.1 basis points higher than expected.
Okay, pause there for a second. 2.1 basis points sounds like a rounding error to a normal person. Why does a tiny fraction of a percent matter so much?
It matters because in the Treasury market, everything is priced to the hundredth of a percent. A 2.1 basis point tail means there was essentially a buyer's strike. Nobody wanted the debt at the offered price.
Wow.
But the really scary number was the indirect bidders.
And who are the indirect bidders?
That category typically represents foreign central banks, China, Japan, Europe. They usually scoop up a huge chunk of our debt at these auctions. But in this one, they only took 62.1%.
Is that low?
It's alarmingly weak. And because they didn't show up, the primary dealers, the big Wall Street banks that are legally required to buy the debt if no one else wants it, were forced to absorb nearly 19%.
So the banks are being force-fed government debt that nobody else in the world wants.
Exactly. And that clogs up their balance sheets. If the banks are choked with treasuries, they can't lend to the rest of the economy. It's a liquidity crisis in the making.
Right.
It shows that the smart money, the global central banks, are stepping back.
Okay.
They're betting against treasuries because they realize inflation isn't a yesterday problem. It's still here.
So let's recap the nightmare scenario we've built so far. Stocks are flashing crash signals, households are leveraged to the hilt just to pay for electricity, private lenders are vaporizing billions, and foreign nations are stopping buying our debt.
Yeah.
If you're an investor listening to this, where do you hide?
Well, the report suggests money is moving.
Yeah.
But it's moving away from paper assets like stocks and bonds and into the physical world. This brings us to the energy and metal sector.
The real stuff. Let's talk about oil first. There is some geopolitical drama here involving Iran.
Huge drama. Iran is rushing to move its oil right now. Their crude exports jumped 200% month over month. They moved 3 million barrels a day in a recent surge.
Why the sudden rush? Are they just having a fire sale?
The report implies they are clearing out inventory before a potential conflict. They want the cash in hand and the product out of the country before shipping lanes potentially get shut down.
That makes sense.
And you can see the panic in the shipping costs.
The tanker rates, I saw this number in the file and thought it was a typo.
No typo. Rates for VLCC's very large crude carriers are up 584% since January. They're earning nearly $300,000 a day.
$300,000 a day just to rent the boat?
It's a war premium. The physical market, the guys who actually have to move barrels of oil, are pricing in a major disruption. Meanwhile, the stock market seems to be ignoring it completely.
That brings us to the other physical asset class, gold and silver. And honestly, the report gets pretty spicy here. It quotes a source calling the silver market an end-of-empire clown show.
That quote really stuck with me too. It points to what the report calls the market integrity crisis. We are seeing these vertical drops in the price of silver on the charts, which critics say is blatant manipulation.
Price setting rather than price discovery.
Exactly. The accusation is that U.S. markets are suppressing the paper price of metals to keep the dollar looking strong. And the report contrasts this with the rest of the world.
What's the rest of the world doing?
Well, India just expelled Jane Street, a massive high-frequency trading firm, for market manipulation. China is proactively closing accounts that abuse paper silver markets.
So the rest of the world is cleaning house, expelling the manipulators, and the U.S. is just letting the clown show continue.
That's the heavy implication. But here is the kicker. Despite the price suppression on the screen, Physical demand is breaking records. Global gold demand was revised up to nearly 4,900 tons. Central banks alone bought about 1,000 tons of that.
So the banks are suppressing the price on paper, but quietly buying as much physical gold as they can get their hands on in the background.
Watch what they do, not what they say. It represents total divergence between the paper price and the physical reality, and that erodes trust.
Right.
If investors stop trusting the price on the screen, the whole system wobbles.
It connects back to that fusion energy point the report mentioned briefly. It seems like the U.S. government knows it's losing the resource war globally.
Yes, the Trump administration making American-born fusion a national priority is highly significant. It's a Hail Mary for energy independence.
Yeah.
They know that in a world where we can't just print money to buy oil anymore, we need a massive technological edge. But fusion is years away. The crisis we're talking about is happening now, this week.
And so what does this all mean? We've covered a massive amount of ground today, from trading algorithms to oil tankers.
If we zoom out, we are looking at a perfect storm. We have record leverage, $1.28 trillion of it. That leverage is sitting on top of a stock market that is triggering the Hindenburg Omen repeatedly, signaling the foundation is totally rotten.
And the safety nets are gone.
The safety valve of treasuries is leaking. Nobody wants to buy the debt. The alternative of private credit is cracking with things like the MFS collapse.
Yeah.
And the underlying economy is squeezing the average person so hard, they are forced to gamble in these markets just to survive.
It's not just a financial crisis, it's a trust crisis.
That's the market integrity crisis in a nutshell. If people stop trusting that the game is fair, whether it's rigged silver markets or rigged stock markets, capital flight accelerates. We are seeing the early signs of that right now, with a massive rush into physical gold and real assets.
It's a heavy picture. But as we always say here on the Deep Dive, it's better to know the hurricane is coming than to be surprised when the roof flies off your house.
Absolutely. Awareness is the only hedge that matters right now.
So here's the final thought I want to leave you with today. We talked a lot about the smart money and the leveraged money.
Right.
If the smart money, the global central banks, the insiders, are rushing into physical gold and shunning U.S. treasuries, and the leveraged money, the retail traders, the desperate folks just trying to catch up to inflation, are chasing stock highs with borrowed cash. Well, when the margin calls start and that $1.28 trillion debt bomb goes off, who is going to be left holding the bag?
That is the trillion-dollar question. And history strongly suggests it won't be the ones holding the gold.
A sobering thought to end on, but a necessary one. Thank you for walking us through the smoke and mirrors today.
Always a pleasure. Keep your eyes on the real data, not the headlines.
And thank you for joining us on this deep dive into the Hindenburg alarm. If you found this breakdown valuable, please make sure to share, like, and subscribe. It really helps us keep the lights on and the research flowing. Until next time.